Hello and welcome to this session on powering global finance. We have two great panelists here, Axel Weber, chairman of the board of directors at UBS and former head of the German Bundesbank, and His Excellency Sheikh Abdulla bin Saoud Al Thani, the governor of the Qatar Central Bank. Axel, first question to you. What is the key risk? We've all this week at this Qatar Economic Forum been thinking about the risk coming down the track for the global economy, as well as the opportunities and some exciting new markets and challenges for business. But you're someone I would want to ask about the key risk facing the global economy today, and particularly whether central banks should be more concerned about it.
Well, I think almost no forecasts show any downside risk for the next, I would say, 3 to 5 quarters. We're seeing a very good start of the year. We'll see a bummer second half. It will only slowly go back globally to an average of growth to 3 or 4%, the usual range. But the difficulty is we'll come from a recovery to a sort of normalization, a big part of the cycle already within 1.5 years. There's almost nobody sees downside risks to inflation, all see upside risk. And I think some of the nervousness around the central bank community, you can clearly see, because whilst they all sit on the mantra that these rises in inflation will be transitory, you actually start seeing, for example, in the Federal Reserve, that members of the committee are worrying more about inflation than they did in the March meeting. Actually, there's a record number since they published the dot diagrams that says they have a worry about inflation risk being on the upside. And that is something that they need to monitor very closely. The risk is that the coming back of the economy, that the normalization in prices, combined with bottlenecks and base effects, will lead to inflation readings we've not been used to for a decade or two. And that may unnerve some investors and consumers. And you need to monitor it very closely so it doesn't become ingrained and embedded in wage price dynamics. We're already seeing positive price dynamics as a result of bottlenecks. If wage demand continues to fall in line with that, there's a risk that this might become more sustained than just transitory. And that's really the risk everyone's focusing on. I see the nervousness in the central bank community really starting to come up.
And just to come back briefly on that, I guess there's two issues here. There's whether the global economy is looking to an era in which there's somewhat more inflation than there's been in the last 10 years, but also whether there's a specific issue around the US and the US potentially compounding the problem with its stimulus. So I'm interested, given your background at the Bundesbank and other places. We spoke to Larry Summers earlier this week for this forum. He has said he thinks that the US macro policies at the moment are the most irresponsible they've been in 40 years. Do you agree with that?
They're definitely the most expansionary they've been in decades. The US had a massive fiscal stimulus. Monetary policy actually hasn't been as expansionary when you look at the balance sheet alone as, for example, the ECB. But look, it's an unusual environment if people like Larry Summers, Olivier Blanchard, or Paul Krugman are on the same warning side as I have been traditionally on warning about inflation risk. So I think both the economists, the community that always advocated massive stimulus, both fiscal and monetary, is getting a bit nervous this time around that we might have overdone it. And I think that first and foremost holds for the US. But there's also a broader issue on there's going to be very mixed signals. And this is a once in a decade or century event. And it's very hard to calibrate this against our models from the past. So I am concerned about inflation overshooting by more and for longer than is currently being priced in inflation forecasts of central banks. They're notoriously unreliable when it comes to medium to longer term inflation trends. And I'm also worried that we'll see a second half of the year where the economy is running really hot, first and foremost the US economy, and that will have spillover and spillback effects into the global economy. The ones that are really at a very difficult point are emerging markets, because the US might tighten and impact on their environment before they actually fully recover. So I think the fallout this time around is more focused on the emerging market spillovers of a premature or even of a late tightening in the US, because it will have effect on certain countries.
Well, that's a very good note on which to bring in Your Excellency Governor Al Thani. Are you concerned that the US is cooking up an inflation problem which is going to destabilize the recovery and potentially down the road pose real challenges to emerging market economies?
Yes, thank you. I don't think there is a risk of inflation. We have seen a recovery, fast recovery after COVID-19, and that has created some kind of demand pull. Therefore, I think that's also some government has also increased their expenditure. And the vaccination and the recovering, which we have seen in the last period after COVID now, we see a very strong demand pull, which can create some kind of temporary inflation. But in the long term, I don't think there is something to, now we cannot anticipate whether there is an inflation or not. But let me tell you, there is a long term. For the last almost decade, we have seen a lower interest rate. This is the only things which we are worried about it, because we have seen some investors has been investing in a very high yield, risky investment, and the borrowers has been very comfort for a certain period of time at a lower interest rate. So I think this is the things which we have to worry about it for the future, in case there is some kind of temporary inflationary effect. But I don't think there is something. Yes, we might see some kind of pressures from the supply side, which cannot meet the demand. And this is, I don't think, something which we are seeing it's a risk, but it's a temporary inflation.
And Qatar has a peg to the US dollar, which protects you from some of the issues that emerging market economies would face, but also clearly has some drawbacks. Could you imagine moving towards a more flexible regime, or maybe needing to, due to the effect on the dollar of these policies?
No, I don't think we will change our regime at this moment. There is no need, but definitely the recovery and the growth which we have seen in our GDP, which we expect this year will be positive, and we have seen it in so many countries. This is something it's will create some kind of inflationary, but it is not going to be something to worry about it that we have to change a regime. I think historical, for us, we are linked to the price of oil, and the price of oil, and the inflation. For us, inflation and the fixed exchange rate regime is really it's an added value, and it's not. It's also mitigating a lot of risk, which we don't think we have to change the regime, because this is only cyclical times, and I think the fixed exchange rate it's done their homework for our country.
We've talked a little bit this week, Axel Weber, about the role of the dollar, and also just what the implications are for the dollar of the policies the US is pursuing. I think economists could argue it both ways. You could say that the very loose policy would suck in a lot of imports and push the dollar up. But if people feel that it's a very irresponsible set of policies, you could imagine down the track a crisis or a run on the dollar. So where do you stand on that?
Look, I think there's no dispute. These were extraordinary times, and in extraordinary times you need extraordinary measures. So the timely provision of fiscal stimulus in the US was the right decision. I'm not talking about the size, but I'm talking about the timeliness. On the size, you can easily argue, but I think you need to look at the combined monetary and fiscal policy response. And in the US, we've seen something that we complained about in the last crisis, that it wasn't there, namely a very early and strong fiscal response, and monetary policy compared to Europe was more muted. In Europe, it was the other way around, less room for fiscal policy to move, so the central bank responded in more of a way. That has helped us to come out with a vengeance of this crisis. Now, looking forward, what is important is we phase out these policies as the economy heats up or might actually overheat in the United States. And that's going to be the big debate. If central banks feel that inflation pressures force them to move rates, will that be happening under negative commentary from policymakers? Will there be pushback? And will they be able to do what is needed from a monetary policy perspective because there is this big debt overhang that has been created and needs to be financed? So I think there's going to be more tension around normalization than last time around, where the fiscal response wasn't as bold, and therefore the withdrawal of that fiscal stimulus with all the effects that will come in terms of next year, we'll see fiscal cliff effects as that policy is faded out, and monetary policy might just have to tighten against the background of negative fiscal effects coming in, and these cliff effects will make the discussion on normalization harder. The Fed exited from zero interest rate last time around and did actually change interest rates and reduce them coming into this crisis, so that helped. They need to provide themselves with that room again once we actually have the economy run on all cylinders, and that will be the case by the end of the year. They should not delay tapering and tightening decisions too long, and I think they're starting with the balance sheet to basically park that at no increase. It'll happen over the autumn. Probably we'll hear the Federal Reserve in October talk about that, and the Europeans need to follow course maybe somewhat later. But the combination of the two policies matters.
And just to push back, I mean, I think in Europe particularly, you're right that the key challenge is going to be managing that transition and indeed building up some further room for policy maneuver on the part of central banks as they come out of this. But that's a very difficult thing to do when you have many European countries actually dependent on the low cost of financing for their public finances remaining in order. There seems like there's a linkage there which is much greater perhaps than it's been in previous times. Countries like Italy, very dependent on these continuing low rates.
Yeah, that's true.
Axel.
But don't forget, there is also a new generation European fund, which is quite sizable, which will actually start issuing European debt with prices around that European debt. The expectation is Europe will have to pay more than Germany to indebt itself in the market. But there's going to be a different instrument in the market, even so it's not huge, where the central bank can look at what is the average European debt that is issued and what does that cost in the market. And that will give it a different parameter in looking at countries' performance relative to the European performance, which is the average. So monetary policy is not going to be as driven, in my perception, by national discussions about their financing cost in the market, and will be able to focus a lot more on the cost of the European level financing in the market, and then make the spread relative to these European debt instruments a matter of national concern and fiscal policy as opposed to monetary policy. So that will help. And in my view, the question is, how large is that premium going to be that the Europeans have to pay over Germany getting in debt, and how much is sort of the discount at which they can issue relative to countries like Italy. But that's naturally then a discussion of national preferences relative to that European average. I think that's why, despite all the shortcomings and problems that this new generation funding has, it has some positive side effects on financial markets.
Governor Thani, you mentioned the oil price. It's around $75 a barrel now, but that's still well below where it got to in 2014. And we've seen GCC countries, Bahrain, Oman, have their balance sheets quite severely affected by that. Are you concerned about that impact? And do you think it's part of your role as a regional leader that Qatar should intervene and support Oman, for example?
Well, maybe I will speak about Qatar's. We this year we budgeted the budget for at the price of 40, and if it's 75, I think this is a very good things for our economy. I think we don't know the other country how they are really affected. But definitely, we believe that 75 for us is good. We are almost now halfway of the year above. So we are looking to see the price will be stable until the end of the year. And this is a very important. I don't know about the others, so I think we are now, we are just getting from COVID-19. And also, as you know, we have also before that, we have some kind of siege and blockade, so it's very important that we are also reorganize our monetary and fiscal policy for any challenge which comes in the future.
But would you see yourself, just to go back a little bit on my question, would you see your role in the region as one of potentially offering support for other GCC countries that are entering difficulties, who might otherwise face a very tough combination of policies to get their house in order?
I think that's always done through the Ministry of Finance, mostly in their meeting in the GCC, and they discuss this matter, So I think the financing between countries and it's not in the agenda of the governors of the central bank mostly,
Well, that's the right answer from a disciplined central bank governor. Just a final one, which is more about the things that we might be talking about in the future when we talk about powering global finance. Digital currencies, crypto has obviously been a huge subject in the markets over the last few months, and something that's also going out into what one finds, taxi drivers and people you meet everywhere have suddenly discovered different cryptocurrencies. I mean, Axel, do you think that this is something that's A, here to stay, or B, something that poses a risk to the global financial system, or makes us want to change regulation, change the way we think even about central banking?
It's not yet big enough to pose a risk to global financial stability, but it's big enough to pose a risk for individual investors that invest in it. I think central banks will not allow any other form of anonymous means of payments outside cash. They will develop tokenized payment opportunities themselves. There's already a pretty widespread means of payments that we have in the private sector. So the technology that is behind that, that technology will play a big role in all segments of financial market. Blockchain technology, I think, is here to stay for good. Digital currencies, tokens are here to stay for good for special purposes. Cryptocurrencies, I think, lack a underlying rationale. They're not a good means of payment. They're not generally accepted. They're not a store of value. And so they don't fulfill the typical functions that you have with cash. They might be an exciting investment about it. I often call it crypto tulips, but that's a risk that individual investors take. It's their choice, but it shouldn't become big enough to be a risk to global markets. And it's definitely not a replacement of fiat money and other means of payments provided by the private sector or by central banks.
We often find that people who say these things still hold quite a lot of Bitcoin. I should ask you, Axel, do you have any Bitcoin?
No, I have Swiss francs and euros, and I don't hold a single Bitcoin, and I don't think I ever will.
Governor Thani, how do you see the role of cryptocurrencies and digital currencies in the future? As a central bank, is it something that you're thinking about very closely?
I think digital currencies, cryptocurrency, crypto or central digital currency, they are very important for us as a central bankers. But I don't see there is a big role here in Qatar, but we are already set a very good foundation. We have a good strategy about financial technology. We have also a lot of research. We are conducting so much research in the central digital currency. But as during COVID-19, we have also financial technologies activities, and there are payment activities, which is also very important. So in the payment, as it's hard for the central bankers, it's very important that we have to be careful about soundness and also the reliability of the payment system. So this is a very important area because we have seen some financial technology has been involved in this payment, and we have also seen some big tech involved in the payment. Therefore, this is a very good, important subject for central bank, that payment should not be, should be reliable, sound, very strong for settlement and also for clearing for our investors. So we are keen about this payment system, that it should be under a very good environment.